Hey, welcome to the podcast, everybody. Thank you for joining me. Appreciate it. It's been a while since we've done a podcast for multiple reasons. A lot of you have been emailing saying, hey, where's the podcast? We like the video podcast. And, at the beginning of the year, I started a new radio program. And so doing the radio program, managing money, and we just moved our offices. So that's a big ordeal and has been for a few months. Purchased a building, going through a full renovation, so that's no easy task. So you combine all of that, sometimes the podcasts get knocked out. We are still going to continue to do them, don't worry, and things will slow down a little bit and we'll have time to do them. But for right now, there's other things that we're pressing. So thanks for your patience. By the way, if you still haven't seen it, we did launch a new website probably a couple months ago, the new eggerscapital.com, so go check that out. And if you're getting the podcast, you probably already are subscribed on there, but there's a free subscription to get all the alerts if you are not yet getting those. So let's get right to the market here. Well, today the S&P was up about 0.4%. Tech and the Russell 2000, the small companies, were up even more. The Dow Jones was up just fractionally, up about 20 points. As you can see here, I'll blow it up a little bit. Lowest trading volume of the year so far was today. So a weak day overall as far as volume's concerned. As you know, I am more into the quality rather than the quantity because we've had volume declining for the last several years. But it is, a little concerning that there's not more emphasis on this market. It does look like it's perhaps digesting a little bit of the gains from 2013 as it's going up, and perhaps it's just plateauing a little bit. Doesn't mean it's going down, but the trajectory has changed just a little bit. And that's okay. We're still kind of moving sideways for the most part, but I want to draw your attention to a couple of things. Number one, you can see how the S&P has kind of been in this range. I'll draw a little box. Basically, just moving sideways up to the top and the bottom here, and we're now approaching the top. But there has not been a lot of demand overall for this market. Fortunately, there has not been a lot of supply either. So it's not that, there's been a lack of intensity throughout all of this, but there hasn't been the intense selling either. Not a lot of supply. And that's why you're seeing the markets just meander and not really fall off a cliff. I would say, though, if you look at this on an hourly picture, we go back to the beginning of the month, we've had these dips, and you can trade these. In fact, let me flip it over to the Russell 2000 because this is one in our aggressive strategy that we did buy this dip the other day on the 15th, and it was because we saw this pattern develop, and we just kept having these quick sell-offs, and then it would rally back. So we are in the Russell 2000, and literally we are looking for somewhere in the order of 3 to 4% for this trade. And we bought a reasonable size in our aggressive strategy, and that will be a trade. So we bought the dip, and that's what you have to do in these markets is you have to buy the fear and sell when people are relaxing a little bit. That's what you do in a sideways market. Now, I want to distinguish between an aggressive trade and a not-so-aggressive trade. When it's falling like this, the non-aggressive person would say, okay, well, I want it to bounce first, and then I will buy. Now, remember, this is an hourly picture you're looking at. So this only goes back, about a month. This is an hourly picture. So each one of these bars represents 1 hour of trading. But as it's falling here, the more conservative person says, I'm going to wait until this is over, until I feel comfortable. Okay, and that's fine. Or they may be reducing their positions as things are falling. That's okay. That's one type of strategy, perhaps one type of person. The aggressive person or the aggressive strategy is someone that is trying to buy when it gets up here, down here, and sell when it's getting up here. That's the trading mentality. In other words, that's the contrarian view. And so that's what we did within our aggressive strategy. Now, again, we have plenty of clients who are not aggressive, do not have that strategy, and so we did not buy that particular position for them. But for those that are aggressive, as it's falling and you have cash, this is where you put your cash to work. As things, and some of our indicators got stretched. It's not that we just felt that this was a magic number. Our indicators did get stretched, and so we simply bought that position. And it was, like I said, a reasonable portion to where when this rallies 3 or 4%, it's real dollars. And so we're looking to take profits, hopefully at the upper end of this channel here. So that's a trade. But going back to the daily picture here, here's the Russell 2000. A lot was made of the fact that it did break its 200-day moving average, which is this red line. And so this pattern has not been resolved yet. In other words, we're not busting on through to the upside. This trade that I'm discussing with you on the Russell was not because we're looking for this. We're not. We were looking for it to move from here to here and perhaps a little more, and then maybe it rolls back over. So this is a short-term trade, but the trend of this Russell 2000 lagging has not ended yet. But I will point to this more so than the 200-day moving average to us is we broke out above. This became a support line right here. Then we hit it again, and now this is the third time. So that's your line in the sand, is this 1085 on the Russell 2000. Remember, this is not the S&P. This is the Russell 2000. So that 1085 was and still is a support. So if you're in this, I don't think you're too late to buy this. Now, this is the third day of one of these turnarounds. We had the first day was on Thursday, this rapid turnaround, and then Friday we had the next day, and then today was the third day. And it could keep going, but you oftentimes see these things go in a few days, 2, 3, 4 days, and then reverse course. So we could get an up tomorrow, and then it maybe reverses back down. But the point of me telling you it's not too late is because we could be setting up for a much bigger move. Maybe we do test the old highs. That would be fantastic. If we do, you're looking at 8.9% up. But if you're into the trading, keep the stop right in here, this 1085 level, because we've seen that level before. It's an important level. So I don't think we're out of the woods, but I will say there's some important things going on that are impressive. And we saw some improvement last week on balance. When I looked at all my indicators, as we do in our shop every Monday morning, we go through every one of our indicators, and on balance, I would say that they improved marginally, just a little bit of improvement. And nothing dramatic, but they did improve. And you can see what's been happening in the last couple of days at least is you're getting some movement out of those safe havens, right? We saw the reversal in, let's take a look at treasuries here, and I'll show you a 5-minute picture. So this is treasuries from the 15th. Remember, Russell 2000 bottomed on the 15th. This TLT, which is treasuries, topped on the 15th. So money has shifted out of bonds and into stocks over the last 3 days. It shifted out of utilities, REITs, bonds, all those things that have been working great this year. It shifted out. Is it a temporary move? Perhaps it could be, but I would say still stay balanced approach right now. I would not lean one direction or another because right now, look, this trend of money going into bonds is still there, and we could have a little more of a sell-off, but let's watch that to develop. And same thing with the S&P 500. I think something bigger may happen. If you look at the S&P, number one, you still have this uptrend in place, even though, as I mentioned, this thing has started to move sideways a little bit, so you got this kind of wedge forming. But I think something bigger is going to happen pretty soon because we're in this tight little range. You can see it. And I don't know if it's going to bust out to the upside or move largely to the downside. I would say overall, when you look at the health of the market, we don't have really anybody winning this tug-of-war battle. It's this tug-of-war, and really nobody has an advantage right now. But there are pockets to invest in. There's plenty of places. Right now, you look at companies like Micron Technology. This is one in our aggressive strategy that's working. That whole group got upgraded today, up about 3.5%. There's companies in there, Altera, which is a semiconductor stock. It also got upgraded. It was up a little bit today. So when you look at networking, when you look at software, those stocks are working in the last few days. So pay attention to those because that's lifting the whole technology sector. When we flip over to Apple, this is one I still remain long and have for a long, long time. Apple, of course, had that big announcement here. The earnings popped, and it never really looked back. Well, today it went above the psychological $600 level. Many started to take profits as it moved sideways, but as we saw so much in 2013, some of these stocks that are strong, they pop up, they just move sideways, and then they keep going back up. I would look for Apple, and I'll zoom out here for a weekly picture here, but I would say with Apple, Can it make a run to 700? Absolutely. I mean, you think about it, percentage-wise, that is about 15%. It could do that very easily. But watch the split coming up in the next few weeks, because when it splits, there's going to be a lot more shares sloshing around. And that may be a time, if you've been in Apple for any reasonable amount of time, that you might look to at least set your stop, or perhaps just plain old get out of it at that time. Because once that that split happens, there's going to be a lot of shares out there to trade. It's going to raise the liquidity up a little bit. So it'll be easier for people to sell and buy. So watch that. But they are going to be coming out with, looks like, the big iPhone, the big one, and probably one that I'm going to upgrade to. And I think remember though, Apple is falling behind in this cat. They should be leading the way, saying, we are the inventors of a big phone and you all should follow us. They're playing catch up to Android phones, right? They're playing catch up, but they're doing what they need to do. They still need to do it. They're still a cheap stock. They raise their dividend, buybacks, low PE, blah, blah, blah. It's just not the most exciting stock. But continue to watch it because it's still working, and it's one that we own and, keeps going up. But we are watching it closely because when that split happens, everybody's going to think that's the time to rush in. This may be the time to go out, but not yet, because it did break out of this little sideways. It was in this little box, and it has broken out of that today. So watch Apple, and really there's nothing stopping it now from going up to those old highs. I just don't know if it'll get there before it has some type of sell-off. So watch that. As far as the volatility, we're down on the lower end again. Remember we talked about this, how volatility, when you see the big spikes, that's your time, that's your easier buy. Well, we had an easy buy the other day, but it was not accompanied by a high volatility, was it? In fact, we're on the very low end, complacency. So we were talking about earlier, the S&P kind of moving sideways and getting into range. Could it give these gains back and just roll back over? Absolutely. Remember, this market has been a market that's all about no trend. Whatever you've invested in this year, if you started investing after this 4-day run, this is what happened to you. If you started getting bearish after this pullback, this is what happened to you. You see, my point is that you start to see a trend developing and you jump on, you have to be in front of the trend in 2014. And that means trading, which some people aren't comfortable with, and it's very difficult, but you have to trade. A stock that we own right now and are aggressive is JetBlue. We bought it down here on this dip as well because we felt like it was in this uptrend and it got to the bottom end, and sure enough, it's popped. And this is kind of our target area. If we get it up to here, it's going to be about a 10% move from bottom to top. Fundamentally, things are even better as well for the airlines. But overall, this is a trade, and you have to be willing to trade. So this is a rental for us. This is not a stock we want to invest in the long run or anything like that. Yes, fundamentals are improving, but this is a trade for us. So, and I'm throwing some of these stocks out there, not that you'll run out and buy them, because I think, frankly, you may have missed this one already. But the point is that there are individual names to trade, but overall the market still is meandering. And when you look at like the mid cap, for example, again, these things are perfectly sideways this year. And when you look at the Russell 2000, it's down a lot from its high, isn't it? And it's just bouncing, but it's still, these things, the Russell 2000 still after this run is down 4% year to date, okay? And you have things like gold, which are up 7%. And gold actually looks fairly constructed to me. Doesn't this picture remind you of Apple? It reminds us of Apple because Apple had this big fall, and then it bottomed out, didn't it? And then it kind of just went sideways, and everybody kind of moved on to something else. Gold could work. Nobody really thinks it can, but we're seeing real interest rates start to fall again, and gold does well when that happens. And so you're seeing that start to run up a little bit. It's been a little lagging here the last couple of weeks, and it had this big sell-off. But overall, I think in the big picture, it may be in this bottoming process. So keep an eye on that. But the things that are working this year are treasuries, gold, municipal bonds, oil. You take a look at oil. Some people ask me what I think about oil. Still kind of neutral, but overall looks like the path of least resistance is probably going to be up, not down. And then we already looked at interest rates. So really that's the full gamut of what's working, what's not working. But overall, I think we've seen some improvement in the last few days, seen some movement back into stocks. But I will tell you, it's not the intensity that we need. We really need some really strong days back to back to get people jumping in, and we're not seeing that. We're seeing really under a microscope what's working, but we're not seeing the overall market work. But there are individual names working. So if you're not comfortable with individual stocks, maybe do a little research and look at some, because there are some names that are really moving right now. All right, guys, that is a wrap. And again, apologize for the delay, but bear with me, and we will get more info to you over the next few days and weeks. Thanks a lot. Have a good evening.